Welcome to your Mortgage Insider Update. It is August the 24th, a new week, the last week in August. This week, the Federal Reserve Chairman will speak at Jackson Hole, Wyoming, in front of world leaders in economics at central banks and from banks all over the world coming to Jackson Hole, Wyoming. So that is a highly anticipated speech. We are always listening out for any kind of hints from the Federal Reserve, but most likely very few hints will come from this meeting. He will speak on Friday morning. In the meantime, we've had a lot happening this last week. The U.S. Treasury announced that they're going to buy back some of their longer-term securities. Initially, this was a real help in the interest rate markets, but after about a day, that subsided. We are maintaining pretty high levels on interest rates, even though they're down slightly today. Definitely a multi-year high. The 30-year bond, which is the 30-year Treasury, not as traded as the 10-year Treasury, and we focus mainly on the 10-year Treasury, but that hit its highest point since 2008 last week. With the 10-year higher across the board, interest rates are not our friend. So we'll take a look, give you a little update, and start your week off right. As I said, the 10-year Treasury down slightly at 4.70. This is a critical level coming down from Friday, 4.70. We're going to take a look a little ways back on the charts as far as where we've been in the last 2 years on the 10-year Treasury. Been well below this 4.7 number just back at the beginning of this year. If you'll remember, this was getting close to 4.1%, so quite a bit higher on the benchmark 10-year Treasury yield. With a little context here, we did see a run up in interest rates at the end of 2025. You can see the pretty steep curve went higher, peaking just above about 4.8%. This black line here is a Fibonacci retracement level of 4.76, 4.75. We are currently hovering just below that, and then the 4.70 had been a pretty tough customer to break above. But with the news this last week, we've bounced right above that 4.7 level and hitting that high point that we have not seen in almost 18 months, or just over 18 months since the early 2025 year started. Now, bringing back that a little closer, we can see that the announcement by the U.S. Treasury last week, August 19th, we dipped below the 25-day average, only to the next day to go right back higher. The move by the U.S. Treasury, Scott Bessent, to try to curve long-term yields by purchasing the long-term existing debt from with funds from the Treasury and likely to issue more short-term debt. Kind of an Operation Twist is what they've kind of deemed it. This was done by the Federal Reserve years and years ago, but the U.S. Treasury actually stepping in to try to curb yields. We saw it bounce higher and then getting right above that level, right close to that 4.75%. We've hit that now on July 31st. We've hovered right near it, touching it on August 18th and again on August 21st. Starting today off, just kind of squeezing in, we've basically maintained these higher levels on the 10-year Treasury yields. That is putting pressure across the board on interest rates. Of course, mortgages are impacted by that, as well as when the Treasury issues their new debt to pay for the government operations, they're paying really high rates on the interest. Last week had a 20-year Treasury auction that was not deemed as a very successful auction, so that kind of plays into why yields moved higher. Briefly, we're going to talk about mortgage-backed securities. Now, the mortgage-backed security price is the price the investors pay to purchase the bond. That if you borrow money in a conventional loan, like a Fannie Mae or Freddie Mac conventional loan, those are pooled into the universal mortgage-backed security. So as investors purchase those, if a lot of buyers come in and want to buy those investments, then that'll drive the price higher. The yield would go lower. So far, that is not really, it's mirrored the opposite side of the Treasury, with bonds actually losing a little bit of ground this morning, relatively flat, but we'll take a look. So we can see very similar to the Treasury, only in reverse. The price had fallen. Get to the end of July, we touched on July 31st on the 10-year Treasury, so that was a low point in the price. The investors were not wanting to buy those bonds. They did bounce back a little bit into early August, but we've seen good and bad days. as things have bounced around, and we can follow the 25-day average to see that we are below the 25-day average in the price of the mortgage-backed security. We are above the 25-day average on the 10-year Treasury. So these are holding interest rates higher. That is really coming into play when it comes to consumers looking to purchase a home, getting quotes on a mortgage, trying to refinance a loan, take cash out, and consolidation. So not a lot of bidders in the mortgage-backed security space. Freddie Mac issues a weekly summary of the 30-year mortgage rates and 15-year mortgage rates. Now, this has been a survey that's taken place since the 70s. All the history is available on FreddieMac.com. The primary mortgage market survey coming in at 6.65% this last week on a 30-year loan. And we can see the upward trajectory. If we go back to the end of July, we talked about since July 2nd, we've seen each week moving higher, 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 peaking just at August the 6th, come down slightly the last couple weeks, but we're hovering in that upper, well above 6.5% range, with 15-year loans coming in just under 6%. So 6% on a 15 year is going to net much higher payment, almost 50% higher on a payment to pay off the loan in half the time. For that, you get a little bit of discount in the interest rate. But for most people, the 30-year fixed mortgage is the benchmark, and that is created some angst in the real estate market as we've seen prices this summer kind of stall. There's been not a huge inventory of homes for sale, but homes are sitting on the market a little bit longer, depending on their price point. Can only feel like these higher levels of interest rates are to blame. So we keep an eye on this for you every week. If you'll follow this page or subscribe here, you'll get the updates when we post them every Monday. We put out our survey. In the description, you can take a look at our newsletter. This video links to our newsletter that gives a better explanation about the individual updates throughout the previous week. So keep an eye out for that, subscribe to the page, and make it a great week.